Silver delivers a lot of utility in fabrication processes. My good friend Frank Giustra quoted a source suggesting that there's no demand elasticity in silver use for solar up to $135 an ounce.
Gold is what you have, to secure your wealth, to be able to buy groceries. It's inflation protection. It's insurance. Silver, has also been money for 5,000 years like gold. Silver has become so industrialized that the world needs it. In the last 5 years, we've had about 1 billion, give or take, if you're looking at Silver Institute's report, and it's not perfect, but it's the best that we have that I've seen. The last 5 years, we're about 1 billion ounces or so, give or take, 100 million ounces of silver short from mine supply to what we need. And so what's happened, all these exchanges, we've had a lot of metal, and these, independent stockpiles are all starting to come down in silver. And so what's happened is the silver price has to go up.
Silver is no longer trading like a speculative metal. It's behaving like a strategic necessity. Industrial demand continues to expand while supply remains structurally constrained, pushing the market toward higher prices. With little demand elasticity and shrinking above-ground inventories, price is becoming the only balancing mechanism left. Rickrule and Robert Kientz highlight a critical imbalance. Over the past 5 years, global silver demand has exceeded mine supply by roughly 1 billion ounces. That deficit has been masked by drawing down exchange and private stockpiles, including inventories tied to the COMEX system. As physical availability tightens, futures pricing becomes increasingly stressed, raising the risk of sharp repricing events. With solar, defense, and fabrication demand showing only minor sensitivity even at well above $100 per ounce, several projections now point to silver moving into the $150 to $200 range during this cycle, with upside risk if COMEX delivery pressure intensifies. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The LBMA and European markets found themselves structurally short of silver, and the spot price for silver was 4 or 5% higher in London than it was in New York or Chicago. So people started taking delivery because they could make 4 or 5% overnight. Simultaneously in the U.S., the lease rates for silver. Many people don't know that there's a lease market for silver, for jewelers, industrial users, fabricators. The lease rates went from 3.5% or 4% to 40% because the people who had been holding silver for lease, myself included, at the end of the lease term, which are very short term, sent the silver to London to make 4% overnight. These are disruptions that are temporary in nature. The disruption that's less temporary in nature, I think, is the coming multipolarity in silver market. Silver used to be controlled in London and in the U.S., New York and Chicago. It's estimated now that 25% of the physical silver that trades in Dubai. That's a big chain. And a bunch of silver trades in China. China, in addition to being a large silver producer, is the largest refiner in the world. About 65% of the world's refined silver comes out of China, which means that Chinese export sanctions don't just apply to silver produced in China, but rather silver processed in China. And the Chinese apparently have come to believe that silver is, like other materials, as much an industrial and strategic material as it is a monetary metal. Now, you have to read a couple of other things into the Chinese action. They banned silver exports from China, except for companies that were licensed by the Chinese state, which is to say their friends and relatives. They've licensed 44 companies to export silver, which is, the sort of rent speaking that you might expect when 10,000 people rule 1.4 billion people. But nonetheless, that will, I think, continue to disrupt the silver. I also might mention that outside of the monetary realm, where I'm more conversant, silver delivers a lot of utility in fabrication process. My good friend Frank Giustra quoted a source suggesting that there's no demand elasticity in silver use for solar up to $135 an ounce, which is to say the reflective properties of silver and the ease with which it is used to coat solar panels means that no significant substitution and no significant fabrication changes will come into the market unless the silver price goes above $130 an ounce, $135 an ounce. So it's important to note that the utility of silver in applications like germicides, water treatment, and solar.
Gold is what you have, to secure your wealth, to be able to buy groceries. It's inflation protection. It's insurance. Silver, has also been money for 5,000 years like gold. Silver has become so industrialized that the world needs it. In the last 5 years, we've had about 1 billion, give or take, if you're looking at Silver Institute's report, and it's not perfect, but it's the best that we have that I've seen. The last 5 years, we're about 1 billion ounces or so, give or take 100 million ounces of silver short from mine supply to what we need. And so what's happened, all these exchanges, we've had a lot of metal, and these, independent stockpiles are all starting to come down in silver. And so what's happened is the silver price has to go up because it has to incentivize what? Investment in mine. Okay. And we'll get to the mines here in a moment. But we've had the silver shortages going on for so long since silver has been elevated. Why the shortages? Well, there is certainly monetary demand for silver, except for silver is not in our money in the United States anymore. And outside of about 2% of Americans that invest in precious metals, whether it be numismatics, old coin, collectible coins, junk silver, old pre-1933 gold coins, new gold coins like the American Eagle and Buffalo, maple leaf, regular rounds, like we have in the Kansas bullion store, whatever, bars, whatever the case may be, essentially, we don't trade it as money anymore. Only about 2% of people trade it. So we don't have a big retail rush here in the United States. Now, there has been a retail rush in India, particularly with silver, but some with gold. You've seen it in China, you've seen it in other nation, that still see the importance of gold and silver in their cultural traditions. Plus, the central banks across the world have been buying gold in particular like mad since 2011. I think 2025 was actually a record-breaking year, according to the World Gold Council. So you see this elevated demand for the metals, but two different reasons. Silver's become industrialized, even though it has a monetary component. Most of the investment in the West is not as a monetary component. It's for industry because silver is used in everything. It's used in electric vehicles. It's used in solar panels. It's used in medicine. It's used in military. It's used in internet. I couldn't record this video without silver. It's used in the iPhone, which right over here. There's silver in this bad boy. There's silver in just about everything we use, specifically electronics, but in every industry, and it's vitally important. So the monetary demand across the world has not actually reached a peak. It's not like we have a failure of the dollar, or a massive worldwide depression just yet. And so what's happening is it's the industrial demand for silver over the last 5 years. It's starting to bankrupt all of the available above ground silver that's not accounted for in an EFP or some investment type or somebody's using as a stockpile like Apple or Samsung or whatever the case may be. And because the mines can't put out enough output, the last several years to handle this explosion in industrial demand of the last 20 years for all these different things, we have the shortage. So silver's coming up faster. The gold silver ratio is coming down. Gold price is rising, but not as fast as silver. So you see that GSR start to even out. It's nowhere near what it would be in terms of what you would expect for mine output, but it's, it's coming down, and you've got silver now rocketing, and silver rocketed after gold. Gold usually goes first. Gold's an indication of financial stress, but silver's launching faster, not just because of world financial stress, because of the demand for it as a commodity. And I think what you're going to see is a separation. The central banks are buying a lot of gold, and gold's going to be a part of the world financial system. Silver, it's going to be more, everybody wants to secure it. For example, the U.S. government pledged $4 billion, 1.5 to buy silver, and then 2.5 to rebuild silver infrastructure. The U.S. also did an $8.5 billion deal to Australia for a range of commodities, including rare earths, gold, silver, stuff like that, other stuff that we need. And silver was declared a critical mineral in the United States in the late summer. So what you're having is the United States recognizes they need silver. They need it industrially. They recognize they need gold, but they're not buying it monetarily because the United States has a different angle to this in terms of central bank purchases than the rest of the world. But gold's going to be for central banks. It's going to remonetize the central bank system. Silver is more used for commodities, and silver is rising faster because of those.
Silver is entering a new phase of price discovery amid physical shortages that are rippling across global markets. A structural shortfall has emerged in London and Europe, where spot prices traded 4 to 5% above U.S. markets, triggering widespread physical deliveries and a surge in lease rates that briefly spiked toward extreme levels. At the same time, silver trading has become increasingly multipolar, with Dubai and China now accounting for a significant share of global physical flows. Export controls and licensing regimes have further tightened supply, while industrial demand shows little elasticity even at well above historical price levels. Over the past 5 years, global silver consumption has exceeded mine supply by roughly 1 billion ounces, steadily draining exchange and private stockpiles. With silver now classified as a critical mineral and essential to energy, technology, and defense infrastructure, the price must rise to incentivize new mine investment. This tightening dynamic explains why silver is accelerating faster than gold and why the gold-silver ratio continues to compress. Let's get back to the interview.
If you think about gold and silver, it's an indication of strength of the dollar and of the U.S. Treasury system. The U.S. is not going to let a hard default if they can avoid it. They would print billions of dollars, maybe trillions of dollars to try to cash settle trades or to maybe buy silver on the open market, put it into COMEX to handle the contract where people are hard standing for delivery really hard as hard as they can. Even though they can force cash settlement, you don't want to force 100% cash settlement because at that point, people know the jig's up and you got no silver. The game of musical chairs up and COMEX has no more silver. So they're trying to finagle the system to support it. But if gold and silver if they go limit up, no price to get the gold and silver because there's a shortage in either one, it implicates the state of the dollar in the U.S. Treasury because the prices will be so high. So the U.S. is going to defend it. So I don't necessarily look at an outright default on COMEX. I think it's a soft default. I think it's been going on for years, since 2009 when we had the end of the Great Recession. And I think it's just progressed, particularly in silver because of shortages. And there's enough above ground gold to make it work, even though it's, they're written on contracts a bunch of times. They can move it around, and there's a bunch of scandals on that. We report on the Perth Mint scandal, so we've seen those. That was almost $1 billion Australian back in the day, a few years ago. So we're seeing all sorts of strain. But each region, because that region needs that trading market because of protectionism, the U.S. is going to try to protect COMEX. The U.K. is going to try to protect the London OTC market. All regions are going to try to protect their market. And that is going to lead to differences in how those markets deliver, how much they deliver, the prices. And so if you're a global bank and you're trying to secure gold or silver, or at least even price exposure on a derivative for your client, you're going to go to different markets. And there's going to be all sorts of these opportunities to make money trading between the market. But I don't think that they're going to let the COMEX fail. We need the COMEX. We need to facilitate trade. And if we're regionalizing our commodities, they're going to protect that. And the U.S. are going to protect it with money, and they're going to protect it with military interventionism, and they're going to protect it with different, changes to the markets. What I suspect is they could limit gold and silver and potential other commodities, leaving the exchange to a foreign body. So they may make the banks report, if they're not already, on who their clients are specifically and to try to protect that. I expect that to happen everywhere. China's already done it. They've done it in gold for a long time, and now they're starting to do it silver with these additional licensure requirements. So I don't think there's an imminent default, but I do think that there's been a lot of issues. The U.S. is going to try to protect their markets. You're going to see regionalization. I've been saying this for 5 years, and now we're seeing it really come to fruition. It's been coming to fruition, but now it's so public that these AI videos or these independent commentators are coming out saying all this stuff. Now, when you listen to those videos, a lot of stuff is not backed up. They said that there was an emergency meeting that happened in the CFTC. It wasn't announced on the website. I didn't see it anywhere. Okay, I didn't see it on the CFTC's website. I didn't see it on the CME Group's website. I didn't see an emergency meeting. There were other things like the silver market was going to default by Christmas Eve. It did not happen. So those are content, I think, that's designed to get you in a panic state to draw up the price. And I suspect, if I'm China or one of these other nations, you may just go in and play around with the U.S. markets and try to break it. And yes, you're going to go to social media and use other means to try to cause a price panic because maybe they want to try to break that market, or maybe they want the price to come up, or maybe they want to force settlement on the COMEX for contracts that they have on it. I think there's a geopolitical play there, and I don't necessarily think it's an individual doing. Chinese guy may be a big hint as to who's actually doing it, right? Now, they may present as Chinese guy because everybody knows that the Shanghai price is higher, and it's Chinese guy, which tends to give it credibility, but maybe that's also indicating who's putting it out. I don't know who's putting it out, just throwing it out there for you.
You will see some increase in primary silver production. That will happen. But primary silver production last year was about 18% of total supply, well after recycling and byproduct production. I think that looking out over 5 years, the increase in the copper price will have a lot more to do with increased silver production than the increase in the silver price. If we were ever to see, again, a good market for lead or zinc, there's a lot of silver produced as a byproduct of lead and zinc deposits. Increases in copper, lead, and zinc production would have more of an impact on the supply side with regards to silver than increases in the silver price paradox. Where the increase in the silver price really comes into play, and I remember this in the 1990s, a fairly large amount of physical silver is held outside the market in India. And if you have increases in the dollar quote in silver combined with a decrease in the rupiah quote in US dollars, you get a parabolic move in silver in India. It's held as a store of wealth by poor people. Back when you were a very, very young man, I dare say a boy, Buffett Warren Buffett owned 15-20% of the world's above ground stocks of silver. When the market found that out, the market doubled, went up another 50%. And all of a sudden the market crashed. The Indian rupee fell by 50% against the US dollar, and the silver price was up well over 100% in US dollar terms. So silver in Indian terms, in rupee terms, was up by 400%. And that corresponded to, and I forget what it was, either a drought or a flood, but a bad harvest for the Indian peasantry. And they had the choice between keeping their silver, which was up 400%, or feeding their families.
Gold and silver prices are increasingly reflecting stress inside the dollar-based treasury system, rather than signaling an imminent exchange collapse. Authorities are unlikely to allow a visible hard default in futures markets. Instead, pressure is absorbed through liquidity injections, soft cash settlements, and behind-the-scenes adjustments that maintain confidence. This process has effectively been underway since the post-2009 period, especially in silver, where recurring shortages expose the limits of paper leverage. Each central region is now defending its own metals hub, leading to fragmented pricing, delivery rules, and arbitrage opportunities across exchanges. As supply tightness persists and geopolitical competition intensifies, metals markets will continue to act as pressure valves for monetary policy. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.